Hello everyone, welcome to our channel. Today we are going to learn about accounting principles. The accounting principles are divided into two, that is accounting concepts and accounting conventions. Here first the accounting concept. The term concept denotes the basic assumption or conditions. The first concept is business entity concept. This concept implies that a business unit is regarded as separate and distinct from the person who supply that capital to the business. All business transactions are recorded in the books of business. Since business is kept separate from the proprietor. Here we have to see the two aspects. The business is separate and the person is separate. Example, if the proprietor invests rupees 20,000 into the business, it is shown as a liability in the business book because the person is different and the business is different. Okay, so the person who is getting the amount, that person is known as a proprietor, but we have to show that proprietor as a liability. The proprietor will be treated as a creditor to the extent of capital provided by him. The concept of separate entity is applicable to all forms of business organization such as sole trader concern, partnership firm, companies, etc. Okay. Next, the second one is dual aspect concept. This concept, basic concept of accounting. The double entry is fundamental to the accounting theory. Every financial transaction involves two aspects. That means it is a dual aspect. Two aspects means a dual aspect. That is receiving aspect and giving aspect. So for every business transaction, here we have to write the two aspects, two effects will get. Okay, here we are taking an example, that is Rama started business with rupees 25,000. Here two aspects will applicable, that is receiving aspect and giving aspect. Receiving, here the business, the organization is taking the amount. Okay, the cash is receiving, and who is giving? The Rama is giving amount to the business. Okay, so two aspects we have to write. And here we are taking the another example, that is rent paid for office premises, rupees 750. Here also we have to consider it in two aspects. Here we are taking a rent for office use, and for that we are paying some rent. Okay, so the cash is giving to the others, that is owner of that building, and here we are taking the service of the rent. Okay, so dual aspect means two aspects will consider. Okay, next the third concept is the going concern concept. According to this concept, it is assumed that the business will continue fair and long time to come at profit. So here we are calculating for a long period of time, and the business calculations will be happen in a fairly manner. All transactions are recorded from this point of view, that is in a fairly manner we have to write the every transaction. It is with this assumption that here we are taking one assumption, that is fixed assets are recorded at original cost and depreciation in a systematic manner without reference to their current realizable value. In other words, we can say that the assets of the business are valued on going concern value and not on realizable value. If it is useless to show the fixed asset on the asset side of the balance sheet at market value, if there is no immediate intention of selling them. Okay, so here we are taking a fixed asset and we are recording on the original cost, and also we are depreciating it. We should not write the directly market value in the balance sheet. Okay, at the time of sale we have to clearly mention the everything in the balance sheet. Okay, so this will be happen. This is a going concern. There is no any changes in the concept. Okay. Next one is the money measurement concept. According to according to the money measurement concept, accounting records only monetary transactions, that is money transactions. The transactions which cannot be expressed in terms of money do not have any place in the books of account. That means we have to write only the money transactions only in the books of accounts. Here we are taking an example that a business owns rupees 2000 as cash and 2 bags of rice, 2 chairs and 1 table. Okay, so these amounts can be added together to produce a meaningful total of what the business owns, if these items are expressed in terms of money. Okay, so we can consider it as cash rupees 2000 and 2 bags of rice is rupees 600 and 2 chairs of rupees 150 rupees and 1 table rupees 100. One may conclude that the business owns that rupees is 2850. So we have to add all these together and write in the books of accounts. Okay. The next concept is the cost concept. According to this concept, an asset is recorded in the books of account at the price paid to acquire it. The assets are not valued at the market price because these values keep on changing from time to time. So that's why we have to consider at what price we purchased. Okay, here we are taking an example that if a business concern purchase a land for rupees 75,000, even its market price at that time happens to the 90,000. Here we are considering for the 75,000 only because at the time we purchased for the 75,000. While writing the accounts, land value is rupees 90,000, but we should consider the 75,000 only. Okay. In case a year later the market of the land comes down of rupees 50,000, it increased and it is decreased to 50,000, then the business concern will show in its book of rupees 75,000 and not the 50,000. That is the cost concept. Okay. Next one is the accounting period concept. It is assumed that the business will continue to exist for a long time period. It is necessary to keep account in such a manner that the results are known at frequent interval. Generally, business concern adopt 12 months period for measuring the income of the business concern. This time interval is called as accounting period. At the end of each accounting period, an income and expenditure account and balance sheet are prepared. The income and expenditure account disclose the income, that is a profit or loss sustained by the business during the accounting period. Similarly, balance sheet reveals the financial position of the business on the last day of accounting period. So this accounting period is considered for a compulsory 12 months. That is a period of time. Okay. So the next one is the realization concept. This concept emphasizes that profit should be considered when realized. It is not always easy to determine when the profit is realized. The question is at what stage profit should be deemed to be have acquired, whether at the time of receiving order or at the time of execution of order or at the time of receiving cash. The accounting is conformity with the law. Recognize that the revenue is earned at the time of goods or services are transferred. In simply, we can say that when the sales are affected, profit will be recognized. Simple ga here we can understand. Okay. So the next one is the objectives concept. This concept implies that all accounting transaction should be evidenced. We should have the any objective that to write the accounting. Okay. So what type of a documents or what type of a evidence we should have? That is vouchers, invoices. Okay. The evidence and supported by business documents, those are invoices. When we sell or purchase, we write some vouchers, okay, etc. The evidence, the business transaction should be objectives, that is free from the basis of the accountant or others. These supporting documents form the basis for record of entries and also for audit. In other words, there is a no place for fictitious transaction that we should remember while writing the accounting entries. The supporting evidence should be objective, capable of verification by auditor. Okay. So these are the concepts while writing the entries or preparing the accounting we have to get into the mind. These are the important assumptions while writing the entries. Okay. So here we are moving into the next topic, that is accounting convention.